Hello and welcome into the KE Report. Chad and Corey here as your host. And today we're getting an update from our friend and activist investor in the resource space, Doc Jones. Doc Jones is an influencer on CEO.ca and X, but he's not really paid by any company. He's just doing things in his own portfolio and sharing that with the space and sharing how he approaches investing and what sectors and what companies have his interest. Doc Jones, always great having you on the show. And I guess I want to kick it up with a discussion we were having off mic here, and it was about how, as a general trend, you're phasing out of some of your precious metals positions after a really good run and putting a little bit more focus on the base metals. We'll get to the base metals in a little bit, but let's just start with the precious metal side of that equation. What are you seeing in the markets as far as the metals themselves or the equities, the gold and silver equities that has you lightening the load a little bit here?
Hey Shad, thanks for having me on. Well, you also have to put it in the context of where I began. Like we've talked about some of my investments in the past, and one in particular that you know of has appreciated by about 15x in the last 3 years, and I tend to be a long only investor. So in that context, when I have a 15x return over 3 years in a gold developer, then I think it's time for me to lighten up, as well as we're at, a little over $4,000 an ounce. The margins are tremendous for gold producers. That is true. But what I'm seeing out there in the macro, as far as the fiscal impulse that is coming, the fiscal spending, the deficits, the recent announcement of pushing through potentially 50-year amortization on mortgages and 15-year car loans, that there's going to be a tremendous amount of demand in the base metal sector. So do I think gold prices will collapse from here? No, I'm not saying that. What I am saying, though, is I think that we're closer to a top or a plateauing in the price of gold, or potentially a pullback as fear recedes out of the market now that the government is potentially going to be reopening the United States, and we have budgets being released around the world that is going to be spending a lot to create GDP growth, employment, and demand on primarily on raw materials and energy, that the fear trade will come out a little bit of that trade that has gone into gold. And just historically, we have an amazing gold price right now. I'd call it $4,000 an ounce. Should gold prices fall to 3,700, let's say, that's a tremendous, tremendous price for gold. And many producers are not getting credit for $2,500 gold. But the fact that the price did come down, call it 10%, I think you'll see a greater depreciation in the equities in sympathy, which always tends to happen in the precious metals market. So that being said, I'm looking more towards, I've been public about this since October. I've lightened up all my positions that are gold and silver producers, developers, and juniors that have that as a primary commodity, and favoring base metal producers that have strong precious metals credits. I think that's the way that I would like to play that going forward. You look at the concentrate market. Like right now, you have copper concentrate. The treatment charges are negative to zero. I was looking at this today, like zinc treatment charges. About 2 years ago, they were $175 a ton of concentrate. Today, they're 35. Copper was 66. Now it's anywhere from zero. Antofagasta negotiated zero treatment charges for their concentrate. And on the spot market in China, there's instances where it's negative $40 a ton, where the smelter is paying you for your concentrate, which is pretty amazing. So that's a boon for all these base metal producers and developers, particularly the developers who are close to production, because in their PEAs and feasibility studies, they have treatment charges that are substantially higher, which means that it's just going to flow to the bottom line, as well as the commodity price, like copper is at an all-time high on the LME. Zinc is doing very well. It's at a 2-year high at a buck 46. You have lead is pretty much flat. And then if you're dealing with a company that has these byproduct credits with gold or silver, you've got silver at essentially all-time highs, gold at all-time highs, and platinum, palladium, which are up 70, 80% this year, respectively. So there's a great opportunity there. And demand for base metals seems to be much more longer lasting. The curves of demand, and those mines tend to have much longer mine lives than a gold project. So all those things weighted together. And considering that I was very well positioned in gold and silver, like most of the companies I invested in have gone up anywhere from 5 to 15x in the last 2.5, 3 years. So that's not yours unless you can keep it. So that's where I'm looking out. And with that too, like there are people saying, oh, well, there might be a recession or we're in a recession. But I'm looking at the energy markets. Like oil demand today is about 107 million barrels a day. It's very robust. And going into next year, the peak demand next year will be around 108, 108.5, with an average of about 107 million barrels a day. So demand is growing. Regardless of all this spending on green energy and trying to pull people out of the fossil fuel demand regime into green energy or using battery power, which, trillions of dollars have been spent to create just an incremental decrease in demand for internal combustion engines. But globally, as a whole, the demand is still increasing every year. Like year over year, we will globally will increase demand by over 1 million barrels a day this year, next year, 1.4 million, at a time where it is now becoming part of the public discourse about the U.S. Permian Basin rolling over in production, that it will peak likely in 2026. OPEC did this publicly. I listened to the conference that OPEC had, and they're looking at U.S. production to flatten out from 2026 to 2028 and then go into terminal decline in 2029, 2030. And the spare capacity of OPEC is being sucked out of the system, where now they likely have 2, 3 million barrels of spare capacity. So 2 years of incremental demand coupled with the Permian Basin rolling over, you're looking at much higher oil prices, in my opinion, in the next few years. And I'm seeing that in the equities too. Like today, if you look today, pretty much every energy stock, oil and gas producer, I have a watch list of about 25, are in the green, whereas your gold equities are predominantly in the red, even though gold is at 4,100. So I think there is a shift of capital moving towards oil and gas as well as base metals.
All right, I want to go back just quickly to the precious metals and the whole theory there of you scaling out of those positions. Look, we got to look at the risk reward here, where gold is doubled in a little under 2 years. So, if for a 2 year outlook, could gold double again? Who knows? But it
Maybe.
seems a little bit harder to double from 4,000 than when it was at almost 2,000. On
Mhm.
the stock front, even if gold does go through this sideways consolidation, we do keep talking about record margins, record profitability, record cash flows from the majors. If we do stay in a low energy price environment, these margins should stick around, maybe not grow and expand the way they have been over the last couple of years. But we do keep hearing from commentators in the sector saying the stocks haven't been rewarded for these record margins, even though they have performed very well. What do you have to say to those people saying, even if prices stay sideways, these stocks are still churning out a ton of cash? The market should be taking notice of the better cash flow, the better financials all around.
Well, I do agree with you. The market should value them more, but for whatever reason, they're not. And for me, for running my own capital, I have to deal with the market that is. And yeah, so should the gold producers get a higher evaluation? Yeah, most likely. And the thing is, I'm not saying that they're not going to appreciate from where they are today, but I run a very focused portfolio, and I'm looking to capture as much upside as I can, mitigating my risk along the way. And I just see so much of a greater upside in some of these base metal developers, partly because they have precious metal credits. For example, Emerita, right, that a lot of people know about. They have a substantial amount of gold in their deposit there, and silver, which, using the clever process by Dundee Sustainable, they're able to get recoveries in the pyrite exceeding 80% on the gold, which is a hell of a lot of money. right? And like there's tremendous opportunities there. And because it's being commingled, those byproduct credits are being commingled with a primary copper or zinc stream. I think that the market will give it more value for one thing, because of the base metal mines tend to run 20, 30 years. So you have a longer production profile. You have the commodity mix of copper, zinc, lead, silver, gold. So you're somewhat insulated from individual commodity declines. Some projects that maybe are being reactivated or had been acquired out of bankruptcy, where, let's say, the gold is running at 0.6 grams per ton. And at the time of when the asset went into bankruptcy, before it was acquired by someone else, gold was at 1,200. But at 4,000, does it make sense to capture that gold? If you can capture even 50% of it? Yes, it does. Most certainly it does. So I do agree that the math says that these gold producers should be valued higher, but I think historically what you see is there's such a boom and bust cycle with gold that is protracted, that people begin to discount the bust a lot quicker than before. And also, someone entering in the market today is a lot different than people who entered the market a few years ago. They've already seen a 10x return on a majority of their gold producers. Like even the large multi-billion dollar producers have appreciated 5, 6, 1,000%, 2,000% in some cases, and they're producing substantial margins for sure. But if you also look at the long-term cycles, there's Dr. Stephen Hanke, who was on the Fed board, and he talks about these long-term cycles and how there's an echo with energy prices that tend to follow the movement in gold, but they're delayed by 12 to 18 months. So if that holds true, and empirically it has been true, then we're going to be looking at going forward to margin compression in the gold producers from the very cost of raw materials increasing, energy increasing. And I think it's fair to say that going forward, labor costs across the industry are going to increase as well. So that's why I think partly the gold producers are being discounted for their tremendous cash flow at this time.
Yeah, some great points, Doc Jones, as far as if you're looking at the costs start creeping up, if prices start to plateau, then you're going to have margin compression again, whether it's the labor or the energy side of it. And it's an interesting drag factor on the energy market compared to the gold market. But they're still doing pretty good at this point in time as far
Yeah,
as
yeah.
there's pretty fat margins. But I think the other point you made that was pretty interesting, and I want to dive into this with you, is looking at ways to get base metals companies with good precious metals credit. You already brought up Emerita Resources. I think it's a great example. And we've talked with David on the show. He's trying to
Mm.
get that better recovery rate of the gold. And it's two of the three projects that have the precious metals component. So that's something that maybe gets lost in the news cycle, but they have that nice kicker. But I know there's
Yeah.
another company that you invest in, Magna Mining. We've talked
Oh,
about
yeah.
them before. They have obviously the copper forward and the nickel, but they also have the PGMs. And you were just talking about platinum and palladium. So does that
Yeah.
factor in there that you like the PGM angle?
Oh, for sure. Well, with Magna, their best years are in front of them next year, because right now they have their McCready mine that they're optimizing. But most people don't realize McCready had a historic stream by Franco-Nevada. So pretty much the way the math works out is 7 out of 10 ounces of precious metals goes through that stream at a discounted price, right? But next year, once they get into Levack, whether it's the R2 zone that they're delineating now, if they start with that, and that opens up to be another Morrison style deposit, or they start with the Keel zone, both of those zones are outside of the Franco-Nevada stream, which carry high grade precious metals, gold, platinum, palladium. There's a bit of silver there, as well as the high grade copper. Like Magna's at this point my largest holding. I've been adding to it with the proceeds from selling of my precious metals. Right after the big pullback that we had when gold went down $400 or $500 from the high, and Magna went from 330 down to 230. So I started increasing my position then, because they have the best of both worlds. You have copper, which is in structural deficits for the next at least 5, 6 years, where treatment charges are negative in China right now, and they're producing actual input. The price today actually affects them because they're actually mining high grade copper today. And then next year, as they develop Levack and put Levack back online, then they get to capture the full spot prices of the platinum, palladium, and gold, which is phenomenal. as well as the high grade copper. So yeah, Magna is great, and that's also they're in production. They've got like 70 million in cash. They have a new discovery there at Levack, and their mine is fully permitted. Levack will come on stream next, and then we have Crane Hill, which doesn't have a stream on it either, which has some decent precious metal credits there, as well as high grade copper, and then Podolsky. So yeah, they are fantastic. And they too, I first talked about them 3, 4 years ago on your show when they were about 28 cents, and they've executed and the price has appreciated with the execution. And in the end, that's what you want. The story and narrative is great for short term, but management has to execute, and they've been flawless. So yeah, I think Magna, fantastic.
Are there any other stocks that are maybe exclusively base metals that you're interested in, or is it all still these hybrid companies that, in all fairness, they aren't the major producers out there, but they are these growing producers?
Well, I'm talking my book here, obviously, you know. So recently, one of the acquisitions to my portfolio now is Canadian Copper, which is a very small company that most people don't know about. This is a company that market cap today, fully diluted, is about 40 million. They're closing tomorrow a $15 million private placement, 6 million of which goes to the acquisition of the 3,000 ton a day mill that was on care and maintenance from 2022 from Trevally, as well as they also get the Caribou deposit, the underground deposit, which is about 10 million tons that runs at about $500 a ton of zinc, copper, gold, lead, and silver. But that's not what they're going to be mining initially. They're going to be mining from the Murray Brook, which is 10 kilometers away. But in the deposit at Murray Brook, the gold runs at 0.6 grams per ton. So they're looking at capturing that. And they'll produce their 800,000 ounces of silver in the byproduct credits per year. In the PEA, they use the price of $27. So at the current spot, there's an extra 20 million US that's not accounted for in the PEA that goes right to the bottom line. And then with the backing of Ocean Partners. Now, Ocean Partners, if people aren't familiar, is a multi-billion-dollar company that markets concentrate. So they, in essence, already have offtake for their concentrate. And Ocean Partners is also a large equity holder of the company. And in that case, what is great about that, like I touched on it before, is for one, the gold was never contemplated. Trevally, when they had the Caribou complex, they never captured the copper or the gold. They had bought the copper circuit but never installed it. So they'll be installing to capture the copper. Right now, they're working on the metallurgy to see if they can capture the gold, which is really exciting because that's going to add tremendous amount of value if they can do it. But if it turns out they can't liberate the gold, that's fine because it was never in the PEA, never in the economic studies to begin with. But I look out there and we were talking about silver and gold producers, explorers and whatnot. I see developers in the silver space that their goal is to produce 1 million or 2 million ounces of silver equivalent a year. And they're garnering 150, $200 million market caps. Whereas Canadian Copper, in their PEA, they're going to be producing 800,000 ounces of silver as a byproduct. And they have at current prices, the NPV on this, an NPV 7, using a 7% discount, is incredible. The IRR is over 70%. And the capital cost to get into production, because it's already permanent and all that, is 58 million Canadian. And every year at current spot prices, they'll be throwing off about, at current spot, 88 million in EBITDA. And that's the kind of torque I'm talking about with some of these projects. It's fantastic. So there isn't any like just pure base metal projects that I'm involved with. It's really hard to find one that doesn't usually have some kind of byproduct in the precious metals. So yeah, that's kind of what I'm looking at.
Well, I think those are some good thoughts on the base metal stocks, Doc Jones. But another sector that we got to squeeze in here before we wrap is the oil and gas sector. It's been in the hurt locker this year. It's been one of the commodity sector that hasn't been as robust, but I know that it's something you've invested in for a couple decades. So just curious your thoughts. Are you active right now? Are you looking at US or Canadian companies? Do you think it's a good time to buy, or is it an avoid sector for you right now?
It's a case by case. Like my two largest holdings in oil and gas are at multi-year highs, so I can't really say that it's been a bad year in that regards. But they have catalysts, which And you always need a catalyst. I use them primarily for income, but I only take a large position if I can see that there's a catalyst. Like Cardinal Energy in Canada, they had a SEG-D project where they're bringing online, and they started injecting first steam last quarter. And now they announced today, actually, that the production is at 4,000 barrels a day of heavy oil, where at this point in the curve, they only expected 3,000. So that's a bonus. And the thing about these, call it oil sands projects, is that they're manufacturing processes. Like this thing will pump out oil day in and day out for 20 years with very little to no decline rate. So those projects are great. As far as oil and gas, I'm very much more interested in Canada on the individual stock basis. My investments in individual equities are in Canada. Now for the US, I do use an ETF that holds 20 different producers in the United States, and they also write covered calls against the position. So it generates a tremendous amount of income. It's like 13% a year paid monthly, but my upside is capped a little bit there. But its primary focus is for me to generate a sustainable income, which it's been doing, and the fund has appreciated nicely as well. But yeah, I think with the electrification and the demand that we can see going forward for natural gas, particularly operators in the Deep Basin in Canada that have access to egress to the coast now that the LNG terminal is open there, and there's two more that are coming online in Canada, as well as the ones in the United States, which should at some point pull up the price of Alberta gas and put a floor under gas in the United States. So that's kind of how I'm sitting there. I'm not looking for a tremendous run in oil and gas in the next year or two, but I think long term it's going to have its day again. And in the meantime, collecting an 8 to 12% dividend yield on production that is hedged with little risk to the downside as far as operations. The oil and gas now in North America is very much a manufacturing process. It's not wildcat exploration. In a lot of cases, you're only paying for the producing, and you're getting the behind the pipe and the proved non-producing and the P2 reserves for free, and you're getting 20 years of production life with that too. So it's boring as hell, but yeah, it's a really good industry. And the idea that we're ever going to get off oil and gas in the next decade or 2 decades or 3 decades is, even if you took transportation demand out of the mix, you're still looking at 70 million barrels a day of demand. And the world runs on oil. That's the way it is now, and it will be for the foreseeable future. With AI, all these data centers, the majority of them are going to be powered by natural gas. That's the only way to get them online in the next 3 to 5 years. Building a nuclear power plant, you're looking, what, 10, 15 years? So I think it's a safe bet that way.
Well, I think that's a great place to wrap it up. And we really went around the horn there, from the precious metals into the base metals into the energy sector. So a lot of good thoughts there for people to dive into. A couple interesting companies we dove into and just sectors in general. And it's always great having you on the show, Doc Jones. Appreciate you spending some time with us. And people
Sure.
should check them out. We'll put a link down below so you can check them out on CEO.ca or over at X.
Yes, great. Appreciate it. Thanks, guys.